The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Tuesday the 14th, 30 to the close. What do you need to know out of Europe? Boris Johnson laying out contingency plans, including booster shots to protect the UK from a winter surge in COVID cases, and lockdowns that ultimately could follow to be avoided. Gas prices continuing to surge. They're up by 6.5% in the UK. Output from coal plants rising as well. Governments stepping in to protect consumers. We're seeing that around Europe. The EU's climate chief warning that Europe must not see these price spikes as a reason to slow the energy transition. And luxury stocks, LVMH, Kering, Richemont, etc., sliding sharply as the sector is downgraded by Alpha Value, which describes the industry as, quote, very vulnerable due to its reliance on China. We're going to speak to the analyst that has made that downgrade. Quick look at the markets just to show you what has happened. As we've noted, the inflation data out of the States initially pro-equity. That has not lasted long. Equities turning tail. Europe down by just 0.2%. But there's the price spike that continues in gas prices. That's UK gas prices. So they were up 6.5%. They were a few minutes ago. They've dropped a little bit. We're still up by 5.9%, Alex.
Yeah, that initial reaction of, ooh, this is a Goldilocks scenario when it comes to inflation, that faded pretty quickly, whether it's because you're looking at a margin squeeze for equities or because the Delta variant is weighing on demand, which is then weighing on those prices. The S&P is lower, only utilities and healthcare now in the green. The Russell 2000, which initially did really well when it comes to the inflation number, is now down by 0.8%. And the real action is definitely in the curve and in the bond market. So the 10-year yield is now down by 5 basis points around the lows of the session, below the 50-day moving average. And you're seeing sort of a bull flattener here on the curve. The pressure really in the long end here, and we're down by over 400 basis points for the curve. The dollar index is now flat. There was an initial drop with the dollar as you're sort of maybe we're going to push off a Fed taper. Is that now the conversation? Weaker dollar story. And now we're pretty much flat as some safe haven buying now coming in as equities really take it on the chin, Guy.
Yep. Let's get back to what is happening at 10 Downing Street, where the UK Prime Minister Boris Johnson, we've also got Sir Chris Whitty, Sir Patrick Vallance, speaking now at 10 Downing Street, briefing on what is happening with the winter plan, the COVID plan for the next few months. What we are learning is that we will see booster shots, that we are not ruling anything out, that there are still reserves in place, such as passports, vaccine passports, possibly even lockdowns as well. Maybe I'm getting a little ahead of myself. Let's talk about the takeaways from this briefing. Here's Adam Blenford. Adam, what are we learning about what was being said at 10 Downing Street?
We're learning, as you say, Guy, that the government in the UK and the health officials are attempting to perhaps thread the needle, sort of lay out the path forward for a country which has been very badly hit by the pandemic and continues to have very, very high caseloads of COVID-19. We're trying to sort of set out a path through the winter, knowing that as the temperatures start to drop, and as you said a little earlier, we all start to stay inside our houses and huddle from in the cold with the gas prices going higher, it's likely that we'll see higher levels of infection. And so they've laid out plans to roll out booster shots to over 50s for a third dose of mostly the Pfizer vaccine, mRNA vaccines in the main, as well as yesterday talking about making eligible 12 to 15-year-olds in schools mostly to have one single dose of the vaccine in effort to increase immunity and reduce the likelihood of hospitalizations and serious illness around the country in the winter. They're hoping that by doing that, it'll mean no further stringent measures, no return to mask mandates, no return or no introduction of vaccine certification or passports, as you might put it. But it's an uncertain road from here, and even the Prime Minister is saying as much.
Yeah, that uncertainty, a huge factor going forward for the economy. Adam Blenford, thank you very much indeed. Let's dig into that uncertainty and the economic implications. Fabrice Montagna, Barclays chief UK economist, joining me here in the studio. Nice to see you in person, finally.
Well, thank you for the invite.
Well, thank you for making your way through our testing regime. Let's talk a little bit about what Adam was just talking about there. Huge uncertainty. The Prime Minister is laying that out. What does that mean in terms of the way you're viewing the economy and the way it's going to develop over the next few months?
Listen, it means we're entering a phase where every percentage point counts. I mean, we had a drop down of 20-25% last year. We recovered most of that. But the question now is whether we'll recover to 100% or only 99%, and how much will we lose along the way. And I think at that stage of the recovery, every bit of certainty counts. And what I heard a lot from you guys here in the summary is uncertainty. Nobody really knows, and that doesn't necessarily help. We don't know whether a passport is the best way forward, but at some point, decisions need to be taken for the economy to be able to function within a given framework. And I think, you know, when we ask ourselves, why has the UK been hit worse than other countries? Why has the UK had more recourse to furlough than others in a more prolonged way? Possibly this uncertainty, the fact that, you know, the government, but also everybody else didn't really know what to do with the situation may have played a role. So at this stage, I think we need the government to step up, to give us guidelines, to give us, you know, maybe not rules and regulation or strict lockdowns, but at least ways to function.
Fabrice, I was going to say that it does seem, though, that uncertainty is part of what we're dealing with the virus, particularly if it becomes endemic. We're just going to have to get sort of seasonal shots, or we don't know how long it's going to take necessarily to eradicate, and if we'll have a hybrid recovery or a stay-at-home recovery. Fabrice, how do you model growth on that?
Absolutely. Listen, we are always obviously hesitating between a situation where COVID becomes a permanent feature or only a cyclical feature. But either way, we have a lot of viruses that are around every year. We kind of learn to operate within that framework. The thing I was questioning here is that we need that framework. Everybody needs that framework, right? Once we have it, whether you operate with vaccine passports, whether you operate with given rules to travel, once that is in place, the economy is able to plan ahead. And I think that's missing right now. Do we know how to plan ahead in the next 6 months or a year? We don't, and I think that would be something that's helpful. And you know, it's not only about the virus. Think about the fiscal plans. I mean, for now, the only thing we're left are tax increases, and which are good or not. Let me not judge this now, but we also desperately need something that shows us the way out of this crisis. You know, new spending, new opportunities. I mean, we're talking about climate change, but we desperately need a roadmap here, a more credible roadmap out of, or rather into that transition, and that's also missing.
What is the base case over the next few months on the employment picture? Do higher vaccinations mean higher employment? Does the supply side of the labour market start to come back? Do we understand at this stage, when the furlough scheme ends, are we going to see a big spike in unemployment? And how is that going to distort maybe the data that we're looking at now?
Listen, what we like in this morning's data, for instance, is that we have the certainty, or at least we have more confidence, that this economy is on the right track. We are creating jobs every month now, already for a couple of months. And that's, you know, a big reassurance going ahead. Now, as you point out, the end of furlough will be the crash test for this recovery, and whether or not workers will go back to their jobs. Right now, and I think, quoting Governor Bailey, it's all about filling the jobs. So jobs are there. It's just about workers having possibly something else to do. Let's see how it happens in September, October. But just to finish on that idea, I think we need to be clear that that process doesn't happen overnight. It takes a couple of weeks, it takes a couple of months, and that's okay. Remember the previous crisis, it took 10 years for the labor market to feel somewhere close to hot or running hot, right? Well, so if it takes a couple of quarters, we should be happy about
Fabrice, that's just dealing with, say, COVID and the furlough scheme, but the other wild card is Brexit and sort of what that did to the labor market. So even if the furlough scheme runs off, even if these companies and these industries raise wages, what part of it is structural now?
Listen, the way we approach this is that part of the reason we are cautious, part of the reason we may be below consensus in some of our forecasts is because of Brexit. Brexit is a price that you pay over several years. It hasn't been paid any given quarter or at some point in the past. It's something that will stay with us for longer. And in the current context, what's important to have in mind, I think, is that Brexit just makes everything worse. It makes labor market shortages worse. It makes international travel worse. It makes supply chain disruptions worse. So in our forecast, we do have something, think about 0.5 point of GDP every year. That is for us a reason to be, below others' forecast, because we think that's the price of Brexit any given year, right?
And as you say, that's going to have an inflationary impact. You highlighted the areas in which the economy is producing some of that inflation right now. The labour market, we're seeing supply shortages. We're going to get data on inflation. Do you think you referenced Governor Bailey, do you think for the Bank of England, the inflation box has already been ticked? i.e. inflation is already high enough to justify a policy response, but they're basically a bit like the Fed, almost, just waiting for the labour market to become a little bit clearer before they can actually start taking policy action?
So listen, I wouldn't be on that line, because for me the only box that the Bank of England ticked is the fact that inflation is temporary. We heard temporary repeatedly in their statements. So whether it peaks at 3, 4, 5% is irrelevant at this stage, as long as you can make the point that it's falling back in line with your target afterwards. And that's what it's doing in the bank's forecast, even taking unchanged interest rates. So that's where a little bit of confusion is, in my view, on what the Bank of England is actually saying. Is it saying that it has seen enough to be happy to hike, or is it saying something else? Remember years ago with Governor Carney, we already were in a situation where the MPC liked to promise a hike, but tended to under-deliver on that hike. I think structurally the MPC likes to think that there's a normalization path, and that path implies higher rates. But whenever that happens, or if that happens, that's another story. So in my view, labour market is one element of that. But take activity in the second quarter. We are now on course for something that looks like 1.5 or 2% growth in the third quarter, in the third quarter. And the bank is forecasting 2.9, was forecasting 3.9 before taking into account the Delta surge. So we are way off the mark on growth. So we are in this policy trade-off between talking tough against inflation, but talking in contrast to activity data that for now is disappointing.
So both of you guys then are definitely bumming me out. It's good that you're together over there. Fabrice, thanks a lot. Fabrice Montagna, Barclays chief UK economist. All right, coming up, it is the story that we can't seem to get away from. We just talked about with Fabrice. That's Brexit. BOE Governor Andrew Bailey talking about its impact on clearing houses and the future of the City of London. That's next. This is Bloomberg. The Bank of England issuing fresh warnings to the European Union over the post-Brexit plans on clearing houses. BOE Governor Andrew Bailey gave a few hints to Bloomberg's Francine Lacqua as part of our Bloomberg flagship series on the future of global financial centers. And she asked if a temporary authorization on clearing houses that expires next year will be extended.
First, obviously, the decision is obviously on the EU side in a sense. I mean, I think the UK has made it very clear that we are in favour of, we'll make that equivalence permanent. I think, look, over this period, the business of clearing houses really hasn't changed much. So they've been, we've all been focusing on the COVID crisis. They've done their job. So we arrive at, this point, as you say, with the sort of the clock ticking, as it were, on that period. With, I think, the industry having proved it does its job. I think users of clearinghouses want to use the architecture they've got. There is, of course, very substantial benefit from cross-currency clearing, having cross-currency clearing and clearing that you can net across currencies. That's what big UK clearinghouses deliver. I think all the evidence is that's what users want because of the efficiency of it. And they want to go on using that.
Is it going to be a political choice from the EU?
I think that if they want to take a decision to break the system up, then it's important to consider the risks to financial stability that come with fragmentation. Now, this is not a sort of idle, you would say this, wouldn't you, coming from the UK Central Bank. That's a real threat. Again, we put central clearing at the heart of the system post-financial crisis for a reason.
What can you tell us about what banks are doing at the moment? Are they already looking? So they're waiting for clarity.
They're waiting.
But do they wait, or do they start moving things?
No, I think the right thing to do is to wait at the moment. I think that the costs of moving, the costs of fragmenting are too large.
Francine Lacqua in conversation with the Bank of England Governor Andrew Bailey a little bit earlier on. You can hear more on that, the future of global financial centers. You can do that by typing Live Go into your Bloomberg terminal. For more, let's talk a little bit about what has just happened. Tom Metcalf joining us. This is the space that he covers. Tom, the governor was quite forceful in that conversation with Fran. He talked about the risk to financial stability if the EU continue to prevaricate on the decision-making that is required when it comes to clearing houses. Can you just kind of give us a bit more detail on the risks that he's alluding to?
Yeah, it's a very interesting rhetoric he's putting out there. As you say, very forceful. And effectively what he's saying is, currently, or sort of at least until June 2022, when this agreement expires, pretty much all the clearing in Europe can be done through London. What happens if that agreement is not extended by the EU? Because the UK's made clear they're keen to, make a unilateral decision to extend it to the EU themselves. Is effectively, if you're doing trades with EU companies, you have to do that in the EU. So that will take away a big segment of the volume that's done in this central hub of London. And what that really means is extra costs, extra friction. And so the idea of risks to financial stability is definitely a real one. And, in all the stuff we hear about Brexit, it's that is clearly the key topic and the one that's really exercising particularly British officials.
So I can understand why that Andrew Bailey wants to push that back and extend the deadline, and the EU is probably going to want to play some kind of hardball. But from an infrastructure perspective, could the EU take this on by June 2022?
I mean, they could. The cost will be actually on the clients and the people using this service. So right now, effectively, if you've got all your transactions in one place, you can net them off each other. The problem is if you start to split it between the EU and London, it will become very expensive because you can only obviously net off within the EU and then within London. So it's not sort of technically difficult. The sort of risk here comes from how does that interrupt, these trillions of dollars of transactions. And the best analogy I've heard is a bit like effectively when you cross the state lines in the US, imagine if there was sort of a border check every state line. And that's kind of what Brexit has done, at least to the market in London.
Tolls,
or could
so
do,
that's
if they
something.
don't agree this.
We have to pay money, so there's that.
Yeah.
Yeah, it's true. I mean, this is, in terms of the impact, you're basically going to get 25% at a minimum leave-in. And then the worry is it gets even bigger. And either way, there's going to be a loss of cost.
All right, Tom, thanks a lot. We really appreciate it. Bloomberg's Tom Metcalf joining us there. All right, coming up, big thumbs down for European luxury. Alpha Value downgrading the likes of LVMH and Kering, and the stocks are tumbling. More on that next. This is Bloomberg.
Gee, it's Guy in London. Can you hear me?
Yes. Good afternoon, Guy.
Good afternoon. Thank you for doing this. We greatly appreciate it. Alex is in New York. I'll get her to say hi too.
Hi, G. It's Alex in New York. Can you hear me?
Yes. Good morning, Alex.
Good morning. Thank you for doing this. We'll be with you very soon.
Thank you for having me.
You bet.
G, we're going to come in fairly straightforward, the reasons for the downgrade. We'll go from there.
Yeah, okay.
Where is that thing?
Alex is going to bring you in, I think.
Yes, I am. right, some of the biggest names in European luxury lowered today. They're slumping after Alpha Value described the industry as, quote, very vulnerable and downgraded a number of stocks. Ji Zhang, Alpha View analyst, joins us now. Until mid-August, these stocks were doing really well. Why the downgrade?
Yeah, so we downgrade our whole soft luxury coverage today to reflect our increased worries after the recent movement in the Chinese market. So we all know that Chinese consumer accounted for over 30% of global luxury spending and expect to reach 45% by 2025. And now, to be in line with President Xi's common prosperity goal, Beijing has announced last week that they want to eliminate the negative influence of unpatriotic and ostentatious public personalities. So this is already a very clear message for us. In recent months, crackdown on technology and post-education industries in China, 3 hours video game limit for teenagers. I think here we have no doubt that Beijing can shift an industry in matter of hours. So who can guarantee that luxury can be an exception?
Is this going to be a long-term shift? Is this a long-term structural shift that we are now seeing in Chinese demand, Ji?
Yes, actually, we think common prosperity is not only a driver, but a trigger. As I mentioned in my publication this morning, we expect the luxury consumption in China will take a downward arcing trajectory. So the millennials overburdened in China by mortgage and the pension savings, the Generation Z busy enjoy the single economy. So, i.e., no kid, no education pressure, but they need large pension saving. And the booming Chinese local brand, especially clear improvement in quality. So together making younger consumer feel it's unnecessary to pay IQ tax. So we believe those will calm down the luxury spending in the long term in China. And especially, sorry.
Well, Ji, I was going to say, so to that point, for the younger Chinese, have they changed their own priorities now?
Yes, so firstly, with all the public media influencers, so half of millennium Chinese consumer know what they want before they arrive to the shop. So that is truly social media impact. And with the impact of common prosperity, so from my point of view as a Chinese, a luxury handbag cost over $10,000 can never align with the notion common prosperity. So that is the influence of social media. And essentially, the millennium, they care more about attitude, design, style, more than brand. And they are more confident, patriotic, and they think local brand is not less quality than international brand.
Ji, we're going to leave it there. Really interesting note that you published this morning. Massive reaction in the stock market as a result of that. Ji Zhang, Alpha Value analyst on the luxury sector. Thank you very much indeed. LVMH down at 1.5%, Richemont's down by 3.5%, Hermes down by 1%. The luxury sector, Alex, coming under a little bit of pressure. And I think we should draw a line between what is happening here with these luxury stocks and what is happening. Apple's about to produce numbers later on. China's still a big market for them, and some of these other names could be really affected.
Yeah, I also think it's interesting looking at retail ahead of tomorrow. I think H&M and Inditex are going to be reporting as well. Supply chain and sourcing is becoming increasingly important, as you just heard, in terms of the millennials. So, like, how does that shift buying patterns?
I also think there's an environmental fast fashion impact as well, 100%. Which I don't think we talk about enough. And that, I think, is going to be changing the nature of fast fashion really quite considerably. That's what the numbers look like. We'll do the details in a moment. This is Bloomberg. So we're wrapping up the equity session here in Europe. Mixed picture. The data out of the States actually probably the biggest catalyst this afternoon in terms of stock movement. We've seen the basic resources sector come under a little bit of pressure as the afternoon has progressed. The luxury sector, we just talked about that. The alpha value downgrade also hitting that sector pretty hard. Those are the two sectors that are affecting London and Paris. So London down by around 0.5%. Similar picture over in Paris. But it's those two sectors, the miners on the London side, the luxury stocks on the Paris side, that are really dragging those markets down. The DAX is fairly flat, and other markets around Europe looking pretty similar as well. But those two main markets under a little bit of pressure right now. Let's talk through the session, show you what has happened, show the key points that we need to focus on. You can see the impact of the US CPI number coming through a little bit more benignly than maybe the market was anticipated. Lower inflation is that temporary narrative starting to manifest itself in terms of the data and the reality of the story. The Fed certainly has sort of projected that. Are we starting to see it coming through in the numbers? We have faded off that, which I think is interesting. The US session, a bit like yesterday, has really struggled to hold on to the early gains. And we've seen that again translating across the Atlantic to a slightly weaker close here in Europe. So we're flat. We're 467. Now, remember, recently we've been up in the 470s. We're in the 460s right now. We're still hovering near record highs. Let's show you what the sector rotation narrative looks like. It's important, obviously, to get a handle on what is happening there. Technology actually reasonably well bid today. We're seeing the Nasdaq outperforming. Healthcare, the car sector, reversing yesterday's losses, up by 0.7%. Bottom end of the market, I mentioned the miners. They're down by 1.94% today. Banks also under a little bit of pressure as well. Then there's that luxury sector, CP&S, the consumer sector, basically, the discretionaries, trading down by around 1%. So let's show you some names. We just mentioned Xi Zhang's downgrade. We talked to her about the reasons for that. A structural shift may be taking place in terms of Chinese demand for European luxury. You can see the effect that it's had. LVMH, the giant, down by 1.6% today. Another giant out of Paris, Kering, down by 3%. Richemont, down by 3.5%. The luxury sector, which has been a huge driver of French outperformance this year, CAC outperformance this year, starting maybe to fade a little bit. So we'll continue to watch what happens there. But this push by the Chinese authorities certainly having a meaningful impact. That is certainly something that I think our next guest is going to be paying attention to as well. China, a huge challenge for Boeing, but the company upbeat. It sees the global jetliner sales story bouncing back. Mark Allen is Boeing's chief strategy officer. The company unveiling its future expectations for how the industry is going to evolve and how demand is going to evolve. Boeing's down today, down by around 0.8%. I'm not entirely sure that you can draw a line between the two. Mark, great to see you. Thanks for joining us today. Look, you are looking out 20 years. You're trying to get a handle on what demand is going to look like. We've just been through huge amounts of turbulence in this sector, and the demand picture, judging by the conversations I have on a daily basis with the airline sector, remains incredibly cloudy. What's your degree of certainty in terms of how this industry is going to evolve and what the demand picture is going to look like?
Well, thanks for having me, Guy. We are a lot more certain today than we were 12 months ago. At the height of the pandemic in spring of 2020, air travel was down 92% from its 2019 standard. Today, we're looking at domestic air travel that's really recovered in many spots of the world. Very strong recoveries in China, as you mentioned, in Europe, in the United States. And that the ability for us to see the snapback, the bounce back and confidence of the traveling public is a real part of the strong underpinning for the new projections this year for the next 10-year and 20-year outlooks.
Mark, where does business travel fit into that?
Yeah, Alex, I think in many ways what we saw here was demand that was set off over the last year for people who wanted to travel for friends and family, people who wanted to travel to go places, explore the world, and also for some of the really important face-to-face business travel. The business travel overall is still something that everybody's keeping a watchful eye on because companies themselves are not back to their offices fully. We can see that across the United States and Europe and China. And so it'll be the return to the office that really helps dictate the return to business travel as we saw prior to the onset of the pandemic.
A lot of carriers have compensated for the lack of business travel by turning to freight. As I look at where you see the market going, freight is going to play a bigger part of that. Why the confident that freight rates are going to stay high, that demand is going to continue to be there? And do you think as well you're going to face greater competition in that space? Boeing at the moment produces the bulk of the freighters. Airbus is thinking about getting into that space as well, though.
Cargo is a very important part of the market, Guy. Look, before the pandemic, 50% of air cargo went in the belly of international long-haul airplanes. That belly cargo disappeared when the pandemic started because the international traffic disappeared. And so belly cargo was down about 50% at its height. It's slowly come back. It's only 25% down now from before, but still with less capacity in belly cargo and in total cargo availability, yet there's more cargo traffic than before the pandemic. So cargo has actually grown. People want speed. They want the reliability of air cargo. The rise of e-commerce also plays a big role in that. And we are seeing positive net orders in our wide body backlog because in part, the strong demand for cargo airplanes. So we do see a real optimistic view on that. You can see it in our investment choices too. We are going from 8 conversion lines where we convert passenger airplanes into cargo airplanes. We're going from 8 to 13 by 2022. So that's a 60% plus jump just in our output.
So meaning that there is enough space for both you and Airbus to be into the freight cargo market?
Right now, we have the good fortune of being able to provide a whole array of offerings. We, of course, continue to have our 777 freighters. We have 737 converted freighters, 767 converted freighters. And so the competition, which isn't yet in the market with some of the new freighters they're talking about, may be there in several years. But the real weight of cargo opportunity remains a Boeing stronghold. And so we take it as a real privilege to service that segment of the market.
Mark, the recovery we've seen thus far has largely been, as you say, a narrow body recovery when it comes to the airlines thus far. We'll wait and see whether that evolves into a wide body recovery. But at the moment, it's being led by the narrow bodies. You've obviously struggled. You've had challenges with the MAX program. We all know about that. We'll talk more about that in a moment. But what I'm wondering is if you now see an opening within the narrow body market to produce a new aircraft. I'm not talking about a whole new MAX program, but the A321, the kind of the top end of the A320 program from Airbus is hugely competitive. And I'm wondering whether or not you need an aircraft to compete with that and whether that's part of the strategy review and the numbers you're talking about today.
Look, coming out of this current moment, you're right. We can see the narrow bodies leading the way. Low-cost carriers are a very strong part of the resurgence. They have an offering that is selling right into those passenger travel demands that we talked about earlier. So clearly, we do think narrow body matters, and share is shifting. You'll see in our projections for the Boeing market outlook that we will rise from 64% of share being narrow body to 68% over the 10-year path. So clearly, we think it's a really important spot to be in. Our commercial airplanes team is spending a lot of time with the customer, thinking about where their fleet and where their route needs will go over that timeline. And that will dictate what airplanes the company invests in over time. Clearly, we're not here to make any news today about the airplanes because we're just really importantly starting today making news about the market, which is something people have been waiting for a while. But it's time for all of us to prepare for growth, and that will affect our strategic planning.
Will that growth be coming from China? You're a former president of Boeing China. You know exactly how that market works. When are we going to get clarity on whether or not we're going to get recertification of the MAX? And looking forward, like you've got a huge time frame here that you're talking about here, Mark. When do you think COMAC is going to be a serious competitor? It's a duopoly at the moment. When do you think that changes?
You know, the MAX has returned to service now in over 140 countries. We feel great about that. You asked about the China market path to return to service. We had a test flight with the regulator in the market in the middle of August. And we continue to work very closely with the regulator on all the technical elements that will lead up to certification in China. So as we do all around the world, we follow the regulator's lead in timing, and we're making great, confident progress in a number of jurisdictions. Just received India, just received Singapore just the other day. So we see the MAX really back strong on its feet, and we're really pleased about that. Go again on your second question, Guy.
It was about the 20-year time frame that you're talking about for this forecast. I'm wondering if that includes the fact that it's no longer going to be a duopoly, that ultimately you will see COMAC coming into the market, that some of that demand that you're projecting at the moment will be satisfied by a Chinese OEM rather than a European or a US one?
That's right. That's right. You know, we're all watching. This is the year where Comac aims to put their first C919 into delivery and service with a Chinese airline customer. Clearly, this is going to be a market with 3 OEMs in it going forward. So we take that opportunity for competition and collaboration very seriously. And we recognize that the dynamics in the market will be shaped differently going forward. But right now, we know we've got a terrific offering. The MAX airplane is just the world's most efficient narrow body. It has been performing wonderfully in service. It's why we've seen very strong orders for it. We've had 7 straight months of positive orders, and in August, again, another net positive month for MAX orders. The airlines are really coming to it because they see it as an important part of their future need.
Mark, as most industries now try and transition in this energy transition, greening airlines is really difficult. You'd have to basically create an entire new plane. You have the option of some biofuels, but the supply just really isn't there. At what point, and how does this fit into your timeline, do you think we're going to have to see entirely new planes with different types of engines, like hydrogen, for example, to satisfy this green transition that we're undergoing?
Alex, you're hitting on such an important theme. Really important that we all address this collectively. We look at 4 different pillars for sustainability in order to ensure that what we do in aviation is good for the world, good for all of us. The first pillar is really around fleet. And so over the last 25 years, we've taken 50% of the emissions out of our industry on a revenue per passenger mile basis. That's an extraordinary amount of reduction compared to any other mode of transit. The second piece is infrastructure. How do we use air traffic management in order to fly in ways that conserve a great deal of fuel and thus reduce emissions? Thirdly is exactly what you said, sustainable aviation, biofuels. And on that, we ask ourselves the question, how do we scale biofuels? How can we do this collectively with the energy industry, with the capital that's needed, with the technology pathways that are in front of us? And then fourthly, there are disruptive technologies. And whether it's electrification, we have our investment in Whisk Aero, which is examining electrification for eVTOL aircraft as one example. Whether it's using hydrogen to create sustainable aviation fuel, another pathway that we think is interesting, but certainly sits out there at the 2040, 2050 timeframe. So we have to wrap activity across all 4 of those pillars to change the world and to really give aviation that home that it needs to be to enable economies, to enable people to connect, to enable precious goods and cargo to be delivered, and at the same time to do it in a way that protects the world.
Yep. And just see how that plays out in terms of money and CapEx outlay, et cetera. Mark, thanks a lot. Mark Allen, Boeing Chief Strategy Officer. Thank you very much. Guy, but that is really the question, right? At what point are you going to have to put in a lot of money to change the kind of products that you make? It's the same thing across all industries.
Well, it's a challenge for Boeing at the moment because in some ways, logically, from a physics point of view, you've got to the point where they've stretched the MAX frame as far as it will go. And the logical thing now to do would be to produce a new aircraft for the narrow body segment of the market. But as you say, the engineering is not ready yet. So you wait and you see what happens and you see how different technologies are going to evolve. And I think that's going to force some of the current airframes to remain maybe in service a little bit longer than we thought. They're not ready to commit yet. Because the technology's not there yet, which is
too expensive.
Understandable.
Even it is,
in some cases, I'm not even sure it's even in existence. I think there's going to be a huge and rapid upward curve in terms of the science, and the technology needs to evolve really quickly at this stage. You talked about some of the sustainable jet fuels. Yeah, that's a temporary measure.
Totally.
Anyway, let's talk about where European stocks are finishing the day. A little tick lower during the auction process, but not much to write home about. Those are the final numbers. London and Paris being dragged down by the mining sector and the luxury sector. The DAX flatlining. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Rizky Gupta, and you're looking at a live shot of the principal room. Coming up, Carsten Kohl, the Sport Trader CEO and founder, joining Bloomberg TV, 1:30 p.m. New York, 6:30 p.m. London. This is Bloomberg.
So gas prices, electricity prices jumping again today by huge amounts. Spain, the latest country, it's going to step in and limit windfall profits for power utilities. This as prices continue to push higher and expected to push higher into the winter. Europe facing an energy crunch. Javier Blas, Bloomberg's chief energy correspondent, joining us now. Countries are going to have to take action. Populations are not going to tolerate the kinds of gains that we're seeing. You and I were chatting just as we were coming in on air. Gas prices in the UK are up 7-8% today.
Yes, they are up 8.5% as we speak. They have been rising through the whole summer. They are up 94% since the 1st of July. And that means that retail prices are going to go also up, although there is a cap in the United Kingdom. But what we are seeing is other European countries. We saw Greece over the weekend. Today, Spain taking action, lowering taxes, taking windfall profits from the power companies. And we have also seen today officials in France and Italy openly discussing the idea of some action because they see also that consumers are getting agitated by the big price increases.
Yeah, Javier, Citigroup says that energy bills could go up like 20% for households all across Europe. Can we turn to coal? Can we go to the dirtier stuff?
We are turning coal in Europe. Germany is burning more coal as we speak. The United Kingdom is firing up some coal power plants tonight to make up for the shortfall of wind generation and then keep the lights on. Europe is turning into coal, that is the dirtiest of the fossil fuels, just as the United Kingdom is about to host a climate change summit, COP26 in October. So it's a bad situation here in Europe with this big shortfall in wind generation that is forcing power companies to rely more on natural gas and on coal.
Yeah, it's sort of a really tricky tightrope there, Javier. Thanks very much, Bloomberg's Javier Blas, joining us. All right, for more now on Europe's energy crisis is Marlon Day, Aurora Energy Research Lead for Great Britain. He's an expert on the power market and has worked with policymakers on UK energy policy and developing power assets. Marlon, thank you so much for joining us. In your estimation, what's the problem? Where are we falling short in what kind of supply?
It's clear, like your colleague just said, we're falling short in wind power. The UK is heavily reliant on wind power, as is the rest of Europe. We're currently experiencing about half the amount of wind generation that we'd normally expect compared to seasonal averages. So that's creating the on top of expensive cost base, high prices.
We're getting a slight glitch on your line, so I'm hoping that's going to improve. So when the wind starts blowing, is this problem going to go away?
To some extent, yes. At the moment, the derated margin, so the amount of spare capacity that we have on the system is very tight, and that's because of the lower than expected wind. So when the wind does return, we would expect that margin to improve. That will reduce the scarcity in the market. However, there will be some upward pressure from commodity prices as well.
It's hard not to look at this, what happened in the U.S. with the Texas deep freeze, although part of that problem is also natural gas as well. Are we having a fundamental storage problem? We just can't store the kind of energy that we need to, and that leads to these higher prices. Does that mean that we're going to have to just deal with higher prices until we get over this green energy transition hump?
Yeah, to some degree, yeah, we do have a storage problem with gas. So at the moment, storage levels are low and the supply of gas is low. And that's what we typically rely on when the wind isn't blowing. When gas stock levels improve, that won't create as much of an upward pressure on pricing. But longer term, we're going to have to deal with fluctuations in wind power. So when the wind isn't blowing, we do need to figure out ways of how to keep lights on. So there are various technologies that are coming to market to try and solve that. Hydrogen and battery storage and pump storage are all ways that we can store up power. But what those things can help us for a few hours or a few days, perhaps. But when we experience long lulls of wind, that's when we probably need to turn to gas.
Mm-hmm. Yep, and the prices are high, and we don't seem to be yet at the price where maybe some of these cargoes start getting diverted back from Asia. Marlon, we're going to leave it there. Thank you very much indeed. Marlon Day of Aurora Energy Research. This is Bloomberg.
All right, coming up in the next 24 hours, President Biden will be visiting Colorado. Also, Apple's launch event kicks off in just about an hour's time. We also have the California recall election with Governor Newsom fighting for that. And a China data dump. Guy, this is going to be interesting. Retail sales, industrial production, that's coming up tonight in New York, Wednesday morning over in Asia. We're going to be looking for that in a key way in terms of growth and what the reaction is going to be from the fiscal and monetary front.
Well, you wonder whether this common prosperity push that Xi Jinping is currently delivering will start to show up in the data. If it's not this time, will it be next time? We were talking about the impact on consumption a little bit earlier on. You would expect that there will be some effect in all of this. So we'll see whether or not we get that in the data. Tomorrow, what do we get tomorrow? SpaceX, all-civilian orbit mission. Looking forward to that. The ECB's chief economist, Philip Lane, is going to be speaking as well. We'll get an update on how he sees this inflation debate taking place. The ECB turning out to be a little bit more cautious. Was that a taper? Was that not a taper? I don't know.
Recalibration.
We'll get some clarity, maybe. Oh, yes, that was the word that we should be using, recalibration. We'll see whether or not he uses that as well. We get CPI data out of the UK, France, and Italy, talking to that point. And to your point about fast fashion, we get Inditex tomorrow, Zara, and Carnival. So we're cruising tomorrow.
We are cruising tomorrow. Also, that'll be a good outlook for sort of what their visibility is for the next 12 months. The rest up for me and Guy on television. Jason Furman, Harvard Kennedy School professor, joins Balance of Power with David Weston on Bloomberg Television and radio, while Guy and I hoof it over to radio in the UK. Bloomberg DAB Digital Radio, the cable. Check us out. This is Bloomberg.